Hello everybody and welcome. We are looking forward on this week and we are wondering what can happen this week in what is in front of us. That is why I want to talk about financial markets with our guest David Jones, Chief Market Strategist from Capital.com. Hello David.
Hello.
David, let's start with crude oil, WTI, which is currently at $43 per barrel after quite a slow upward movement. And of course, tomorrow we will have an OPEC meeting. So my question for you is, what are your expectations on this asset?
It's really interesting, oil. Like you say, it's been, in recent weeks, it's been a slow rise after the massive volatility we saw from sort of February through to June, July. But it is still rising. It is still trying to push higher. I struggle to see, given the fact we're all coming out of lockdowns and perhaps we have further localized lockdowns still to come, I really can't see the world economy is going to be anything near how it was in January, obviously. So for me, I struggle really to see crude oil back at $50 a barrel, which is only what $5, $6, $7 from where we are now. So personally, even though it is still edging higher, it doesn't appear to be a lot of conviction behind the recent strength. So I do wonder if the more sensible trade on crude oil is to look to see if it falls from here. As you said, we have this OPEC meeting, and the cuts by OPEC and OPEC Plus in recent months, production cuts, have definitely helped support the price of oil. So I wonder if do we get a surprise for this meeting? I think a lot is going to depend on what comes out of this meeting. Do they come out and say they're going to continue with production cuts, or actually they're going to return back to normal? So for now, the price action is definitely positive. I just struggle to see another 10-15% upwards from oil from here, given the backdrop of the world economy. So I think we should perhaps prepare ourselves for a downside shock in the price of oil. It's going to be a really interesting market to watch in the next few weeks.
Yes, and this is a very interesting if we look at the volatility of this asset, because most of the time the crude oil is more like a volatility asset, and now we have quite slow upward movement. So that is why I also wondering is may some shock can happen, and we will see, for example, that this WTI will go down, for example, like $40 or even less.
Yeah, I think that would probably be the trade I would do at the moment. I think it can be the trend. The short-term trend is up, and I'm a technical analyst. Look to follow trends, but I think just because, as you say, the volatility has been so low in recent weeks, and when it breaks out to new highs for this recovery, we don't get a sudden surge of buying. It doesn't seem that convincing. So I do wonder, I think like you say, whether actually the way to position yourself is for a shock sell-off below $40. For me, it seems more likely it's going to drop 10% than rise 10% from here. So that's why I think, even though it's been fairly boring the last few weeks, it's a really interesting market, I think, in the months ahead. But I would be tilting towards definitely something of a sell-off.
When we are talking about the crude oil, there is a dollar in the middle, of course, because we are talking how much per barrel costs crude oil. And of course, when we are talking about the dollar, the major currency pair is euro dollar, and we are looking now at a very interesting moment. For the third time we are going to 119, and my question for you, do you think that this time there is a possibility that bulls will break that very important resistance, or maybe now is the time that dollar can gain some strength?
You're right. We're back up to this level for the third time, and it's pretty much the highest euro dollar has been in 2 years. And I think, because it keeps going back to it, it wouldn't surprise me if it broke this week and we saw further euro strength. A week ago, I was thinking we were going to see the dollar come back, because the dollar index, the dollar against the basket of different currencies, was holding above an earlier low. But the dollar this week and over the last couple of days has given up a lot of the short-term gains from last week. So I do think, like you say, euro US dollar is the one to watch this week. Let's watch those highs from over the last couple of weeks, which are 2-year highs. But again, if I was a betting man, I would say there was perhaps a better than 50% chance of it breaking those highs. So we've gone from seeing what looked like the dollar perhaps coming back to actually no, the last couple of days we're seeing euro strength again. So I think it's going to be a really interesting market to watch. Now, we talked about oil medium term. I think short term this week, euro US dollar is the market to watch to see if it can break through those highs.
Looking at the different major pairs, for example, like dollar to yen and dollar to Swiss franc, we are seeing very interesting patterns. We are seeing this downside trends, and most of the time these assets are certain indicators of risk in the markets. Looking at this instrument, do you see the risks? Do you see the risk, or maybe it's just the dollar being very, very weak?
I think that's a very good point to equate it with risk, and we've seen as in the last few months, 4 months, as we've seen stock markets really bounce back. We've seen investors embrace risk. When we've seen all sorts of assets really recover over the last few months, stock markets, oil, gold, silver, and the dollar has fallen. So I think it's a really good point you make that the dollar weakness we've seen in the last couple of days is inverse to what the stock market's doing. If you look at the S&P 500, it's pushing. It hasn't hit all-time highs like the Nasdaq has, but it is pushing back to those all-time highs from February. So I think a massive part of this US dollar weakness at the moment is investors continuing to embrace risk. And I think when we have so many other assets continuing to climb, investors are moving away, understandably, I suppose, from the safe haven of the US dollar. So it's definitely a risk, embracing risk approach is also pushing the dollar lower.
Yes, it was a very interesting topic because looking at the correlation between the US indices and US dollar, it's very, you may start to wonder what is happening on the stock exchanges, especially when we see the dollar is very, very weak, and Nasdaq, S&P 500, it is right, like they all forgot about this recession that we talked about a couple months ago. So I'm very, very interesting about your view on this, stock exchange in US on the US market, and this correlation between this what is happening right now and the strength of US dollar.
I mean, you can't, I think, argue against the strength you've seen in stock markets. I think it was back in June of this year, so 2 months ago now, that the Nasdaq moved to fresh all-time highs, which, like you say, if we were talking about that in March when markets were falling because of the virus spreading, we'd never have imagined that US stock markets would be at all-time highs 3 months later. But you can't argue with this strength. The S&P 500, the broader index, is a tiny amount away from its old high in February. So for now, maybe as unbelievable as it seems, you wouldn't want to be betting against US stock markets. And I wonder, maybe the catalyst to watch is if we see some US dollar strength coming back. If we saw a strengthening US dollar, that would make US stocks more expensive for foreign investors. So perhaps that's something that stops the momentum of the US stock market. But this week, the way things are going, we'd expect the S&P 500 to hit fresh all-time highs. This strength really is incredible. At some point, it's going to end, because I think at the moment, too many people think, it's just easy money. Buy US stocks and they go up, they don't go up, go down for very long. So I think at some point this is going to come to an end. But I'd have to say it's showing no signs of ending at the moment. Perhaps the catalyst is some strength in the US dollar, and we don't have that at the moment either. So there's definite correlation, I think, between a weaker US dollar and a stronger US stock market.
Great that you mentioned about this easy money syndrome, right? Because every time we heard about making easy money, then probably the person that's going to pay for this easy money is a trader, right? The trader that said this quote, this sentence. And it's very important to remember that nothing is easy, and we have to stay sharp and have wide open eyes. Okay, so next thing about today. Today we had monetary policy meeting in Australia, and we saw that US dollar, the Aussie, is gaining in value. So what is your opinion about this currency pair, Aussie dollar to dollar? Well, first of all, of course, we said about the weakness of the US dollar, and then we are looking at the Aussie, and we are wondering after this, of course, a monetary policy meeting. Is it possible that Australia will come back to this? Aussie dollar will come as this currency that is quite hawkish, or it's just too late for that, and now only the Aussie dollar can gain on the weakness of the US dollar. I'm wondering what is your view on that?
It's an interesting one, and there are two things I think with the Australian dollar. It has recovered really strongly since the March lows. I think the euro, we were saying, is at a 2-year high. The Australian dollar is at pretty much a 12-month, 18-month high against the US dollar. It's bounced back strongly. Interestingly, though, a bit like oil, the strength of the recovery has slowed, although it is still going up. But the Aussie dollar, there are two things here. There's the dollar weakness we talked about. Clearly, a weaker US dollar. We will see the euro, the yen, the pound, the Australian dollar all lifted. But also, because the Australian economy is so commodity driven, I think that the fact that we've seen a rise in gold and copper in recent months, let's not forget, it was only 2 weeks ago that gold hit all-time highs. So I think the rise of these precious metals clearly gives a boost to the Australian economy because mining is such a part of that economy. So that's definitely helping. So for now, I think it still remains strong because of these factors, but it has come quite far in the last 3 or 4 months. So I think even though that recovery is still strong, I would be nervous about the Australian dollar perhaps selling off from here. I think like oil, good recovery, but has it gone far enough? And perhaps the bigger move is to the downside. So it's the Australian dollar, US dollar, I think is a really interesting currency pair to watch because of both dollar weakness side of things. Do we see the US dollar turn around? And also the fact that the part that commodities have played. And I think maybe we'll see a weaker Australian dollar, over the next few weeks.
On Friday, we will have PMI data from Germany and France. The forecast, so as the previous readings, was is above 50 points, and it's a very important thing. If we all know that 50 points are the clue. It's the main point on this PMI data. And my question for you is: it is time for recovery in the European economy, or is it too quick to say something like that?
I think, like you say, it will be interesting. Traditionally, anything like you were saying there, anything above 50 shows expansion in the economy. Below 50, we're seeing contraction in the economy shrinking. So it's always even more so now a closely watched number. I think it wouldn't be surprising to have a positive number. And as usual, it's how much it beats expectations. The European economy was struggling, before the coronavirus hit. We had some bad data last year for the German economy, and I think clearly this has been magnified this year with what we've seen with the virus. We are seeing economies bounce back, so it wouldn't surprise me to have a positive number. But I think it's how much does it beat expectations by. If it comes in line with expectations, I don't expect a massively positive reaction by the market, because we are seeing economies bounce back after clearly a pretty horrible time. But yeah, like you say, a really important number to watch, and we can definitely expect some short-term volatility in both currencies and stock markets.
The one thing is the economy, and the second thing is the stock exchanges. Looking at the European stock exchanges, for example, looking at the German DAX, what is your view on this asset? Because we are looking at these indices and on this stock exchange, just like in the United States, and we are seeing that they are going two ways, right? The first thing is the economy, and the second thing is the stock exchanges. So I'm wondering what is your view on how in the European indices are acting, looking at this economy data that we are seeing each week.
Yeah, I think you're right. I think there's a great quote that says that the stock market is not the economy, which I think plenty of us, me included, need to be reminded of now and again, because it does seem a bit unbelievable how stock markets have come back, because clearly we're not going to have an economy like we had 6-8 months ago after the coronavirus. It's going to take a while to get back to normal. But if you looked at stock markets, you wouldn't really believe that, because they've raced away. Saying that, European markets, Germany, France, and of course the UK, have lagged behind what's happened with the US stock market. You'd have made more money, a better return, I think, if you'd been in US stocks rather than in European stocks. So I think there is still some caution in European markets, like the DAX. But like US markets, they are just below where they were in February of this year. And I think if we see this week the S&P 500 in the US move out to all-time highs, we're going to see these European markets like the DAX dragged up as well. They're just going to stay, I think, in tandem with US stock markets. So I think they have been a bit more cautious, the reaction by European investors to what's gone on. But I think if we see continued strength in the US, then European markets are going to follow these markets higher. But it's another interesting one, because the DAX is just below those highs from sort of January, February, before all markets really crashed into March. So it's going to be really interesting if it can break out through those levels this week, but still positive.
So we are looking forward at the next interesting week. David, thank you very much for this conversation. My guest and yours was David Jones, Chief Market Strategist from Capital.com.
Thank you very much. Have a good week.